You've heard others talk about it. You wondered how to do it. How do you avoid paying taxes?
Brian, I am excited about this one because we all know this. There are only two things in life that are certain: death and taxes. And so we can't necessarily tell you how to stave off death, but what we can do is talk to you a little bit about tax planning.
Now, wait a minute. You said it's certainty, death and taxes.
Yep.
I've been watching a lot of social media, and I hear a lot of things are deductible. Do we have any proof of that?
You know what? That's a great point. Check out this clip of someone else trying to share some solid tax advice.
Want to know how I was able to write off this car, as well as this car, and even my entire mortgage payment? I was able to write off all of these things thanks to one strategy: tax fraud. I just call it a business expense when it comes out of my bank account. It's great. I know a lot of people are like, oh, but if you get audited, what would cause the IRS to come and audit me? It's not like they know I'm even doing any of this.
Look, obviously, tongue just pressed
Firmly.
with as much pressure as he could into his cheek. But there's so many content creators out there just like, go start a business. It'll be deductible.
Yep.
And remember, everything is deductible until you get caught. But that's not what we're here for today, Bo.
That's right. Tax evasion is illegal. You can literally go to jail for it. Ask Al Capone or
Willie Nelson.
Or
Oh, we can even think about Wesley Snipes.
Wesley Snipes, right. You will go to jail for tax evasion. However, tax avoidance is highly encouraged. And we literally have an entire tax code that substantiates this claim. So what we want to do is walk you through maybe some of the lesser known things that might be available to you to help you decrease or avoid paying taxes in 2024.
So we're going to be hitting the 5 biggest ways to help you legally avoid taxes. Number 1, by the way, low-lying fruit, retirement plans.
Yeah, Brian, this is an exciting one. And I think this is one that's tried and true. People are aware of this, and it almost seems old hat, but we forget that this might in fact be one of the very best legal ways to hide money from the government.
Yeah, whether it's you avoiding taxes now by taking a current deduction when you fund your IRAs or your health savings accounts, or if it's avoiding taxes in the future when you fund your Roth IRA. There's all kind of opportunities to do Roth contributions, specifically around $6,500 a year in 2023. And then if you are 50 and older, it actually goes up another $1,000 to $7,500.
Yeah, but when we're talking about IRA contributions, obviously there's Roth contributions, but there's income limits. And even if you're going to do traditional IRA contributions, there are income limits even there, depending on if you have a retirement plan available and whether or not you can deduct it. However, even if you are someone who falls above the threshold to be able to contribute directly to a Roth IRA, that doesn't necessarily mean that you can't still do it. You can still do backdoor Roth conversions, where essentially you can fund a traditional non-deductible IRA and you can convert those dollars to Roth. So even if you're above the income limits, there is I don't want to say a loophole, but there is a strategy in which you can still build Roth dollars.
You can definitely do backdoor Roth conversions. Now, look, it does sound somewhat shady, but the government's very aware of it. So much so that when we had tax negotiations in the last few years, this has potentially been on the chopping block as the loophole they were going to close, but it's still open. So you might as well take advantage of this legal way to do Roth contributions, even if you have a higher income. Now, recognize there are some limitations. If you have other IRA accounts, beware, and you need to kind of tread carefully because you need to worry about isolating the basis and other things. It's better if you just make sure that your account is structured properly so you can do a clean Roth conversion strategy.
So we love building Roth assets because of the tax-free nature, but they're not the only tax-free account that's available to you out there. Most people don't realize that health savings accounts can actually be pseudo-retirement accounts. If you're one of the 4% of people that recognizes you can put money in, you can then invest invest those dollars to grow for the future, and then you can pay for qualified medical expenses completely tax-free. This could be a huge benefit when it comes to your overall financial planning on how you're going to build Roth-free dollars or tax-free dollars inside of your financial plan.
Now, I love that you just covered the triple tax advantage. All that is what you do to make your qualified medical expenses not only deductible when you make the HSA contribution, but also when you pull it out at a future time, highly appreciated for those qualified expenses. A lot of people, and it's exactly what you kind of led up to, if you are 65 and older, these can be retirement withdrawals as well. You just don't get, you have to pay some income taxes on that part. But it's still worth noting it's a closet retirement account. So it's a great opportunity to legally avoid some taxation.
So we talked about traditional IRAs and Roth IRAs and HSAs. These are all accounts that you can open up on your own. But another great way that you can legally hide money from the government is through your employer-sponsored retirement plan, whether it be a 401k, 403b, 457, and so on.
Yeah, the defined contribution plans that Bo just covered. Think about this. You get to usually defer up to $22,500, and if you're 50 and over, it actually you get a $7,500 catch-up contribution that allows you to do $30,000 a year. That's pretty incredible, and you get to choose, like I talked about earlier, are you going to take the tax deduction now with traditional 401k or qualified retirement contributions, or are you going to let it be tax-free in the future by doing Roth contributions? Both of them are great if you just know exactly where you are in your tax journey.
Now, what you just said something. Know exactly where you are in your tax journey. There's a lot of things you have to know between income limits and contribution amounts and how much can I do and what kind can I do. If you'd like a guide to help you navigate some of those tax circumstances, we have an amazing resource for free out at moneyguide.com/resource. This is our 2023 tax guide that will walk you through, okay, how much can I make and do a Roth? Or how much do I need to have to be able to deduct my traditional? Or how much can I put into a 401k? If you have tax questions, this quick free resource is a great tool for you to use to navigate finding those tax answers.
All right, so we just covered retirement plans. The next big legal loophole on how to avoid taxes is actually by investing. Now, this is one, Bo. When I hear Warren Buffett complain about how low his tax rates are compared to his secretary, people often go, how does it do that? How's he exploiting the tax code for this to happen? It's because he's an investor. And guess what? The tax code is structured in a way that it rewards investing in capital assets.
That's exactly right. Now, not all capital investing is at favorable tax rates. If you have short-term capital gains or you have ordinary dividends, those are taxed at ordinary income rates. Not all that exciting. However, if you are a long-term investor, you can have qualified dividends and long-term capital gains that are actually subject to lower tax rates. Instead of paying your ordinary marginal rate, you can pay as low as 0%, which we'll talk about, but in most cases, 15% long-term capital gains rates, which is a very attractive proposition for folks who are putting their money to work for them over the long term.
Yeah, so it's good to be an investor, and Bo kind of just alluded to it, and I want to give the details. If you're a person who's either lower income or you've done a great job of structuring your income, especially in retirement, they do have a carve-out for capital gains if your income for a married couple is below $89,250 or $44,625 for single individuals, to where you actually pay a 0% capital gains rate. That's
huge.
Not a misstatement. 0%, meaning tax-free capital gain distributions if your income is low enough.
It's amazing. Another thing that you can do from an investing standpoint is if you recognize, hey, I'm a long-term investor, and different market environments provide different market opportunities to me, tax loss harvesting might be something you want to take advantage of. Even as we've seen some volatility over the past year and then even over the past couple of weeks, you may decide, you know what, I've had capital gains that have come through this year. Perhaps I should sell some of my lost positions to offset those gains, because it's not incredibly difficult to zero that out throughout the year. And if we have a substantial down year like what 2022 was, you can actually harvest those losses losses and be able to use them in future years to offset all of your capital income, even up to as much as $3,000 of ordinary income. So just because the market is down does not mean there aren't silver linings you can take advantage of from a tax standpoint.
And I always like to be strategic. I talk about when you're doing your tax planning to avoid taxes legally, tax location matters. Just like earlier I was talking about that 0% capital gains tax rate. How do you actually make that work if you've been earning a great wage through your working years? Potentially you can use it in retirement. It's not uncommon for us to find people who leave the workforce, no longer have wages, but if they have their three pots of money. If you think about the three baskets of money that you can have tax deferred, which is your employer contributions, as well as your contributions that you took the tax deduction now. You can have your tax free, like your Roth contributions that grew tax free. And then you got your after tax accounts. If you structured your three buckets in the appropriate way, you can actually legally manipulate your retirement stream to the point that you could potentially exploit those 0% capital gains rates.
I love it, Brian. So we're talking about how we can potentially save taxes in 2024. And we've talked about retirement plans on the employee side. We've talked about investing in some of the favorable tax rates. Well, this next one I think is one that gets the most press, the most publicity in terms of people thinking about tax savings. And it's a big one. It is real estate, but it may not be exactly what you've been pitched that it will be from a tax saving standpoint. However, it can be incredibly attractive when it comes to saving taxes.
Yeah, this is one, I love talking about this because it's true. Real estate is one of those things where it has tremendous tax benefits, and it's to the point that I think sometimes people put this at the front of the line where they're letting the tax tail wag the dog. But I don't want to minimize, this is an incredible benefit, but I still want you focusing on the get wealthy behaviors of having steps 1 through 8 of the financial order of operations before you get to this. It's very important. This is a step 8 abundance goal. But once you get into this level of investing in wealth, it's the squeeze of the fruit's pretty sweet, Bo.
And when we're talking about real estate here, we're talking about specifically directly investing in real estate, whether you're doing residential investment, commercial investment, raw land or development, or even real estate syndication. So we're not talking about investing in real estate through publicly traded securities. We're talking about direct investment. Well, one of the big tax benefits, similar to what we said on the investing side, is that when you buy a capital asset, when you buy a piece of real estate and you hold it long term, and if you make money on that asset, when you sell it, you actually pay favorable long-term capital gains rates. So when you sell that piece of real estate, it's not going to be taxed at ordinary income rates. It'll be taxed at the lower capital gain rates. That's a pretty substantial benefit for real estate investors.
But here's the thing. A lot of times you think that you have to choose to be a real estate investor. But here's the secret. A lot of us are real estate people in the best way possible with our primary residence.
Oh, that's huge.
Because think about this, guys. We talk about favorable capital gains rates. There are very few things out there as good as the Section 121 exclusion of gain with your primary residence. If you've lived in your primary residence for 2 out of the last 5 years, and by the way, even if you haven't lived in it 2 of the last 5 years, but you got relocated for work or other things, there are some carve-outs, but primarily it's 2 out of the last 5 years. For individuals, you get to exclude $250,000 of capital gains. For married couples, it's $500,000 of excluded capital gains, meaning 0% tax rate or 0 taxes on those gains. And that's the gain. So I'm talking about you could have bought a $500,000 piece of property that you sold for $1 million because of this big run up through the pandemic. And that's the full gain is tax free if you're a married couple.
Yep.
So because it's only on the gain. Pretty powerful stuff.
But what's really, really exciting is when it comes to real estate, that's on your primary residence. And we think, okay, if I sell this and I have a large capital gain, it'd be great to not pay taxes on that. There actually are mechanisms where even for investors, not folks that are just buying their primary residence, where you can defer those capital gains. These transactions are known as 1031 exchanges. Essentially what I can do is I can sell one investment property, one asset, and then I can go buy a different one. And so long as certain qualifications are met, I can actually defer having to pay income tax on that first transaction, and I can keep kicking it down the road.
A lot of people get excited about these 1031-like kind of exchanges, but I got to go ahead and warn you, there is some prep that is needed. And most people wait until the last minute, and then they're caught, and they get a check issued, and then it's like, oh, God, they've blown the whole thing up. So let me go ahead and give you the things to think about just in case you think you want to jump on the 1031 exchange train. It's, first of all, you can never hold the money. The money's got to be held by a qualified intermediary that can actually do it. So it's typically a trust company or somebody who helps with the closing. They've got to be qualified. They'll very much, if you call ahead, they'll know exactly to say, yes, we are structured to where we can hold your money and we can make sure it's held appropriately. Don't wait until the last minute. If you think you're like 2 weeks from closing and you're going to tell them, hey, by the way, I want to do a 1031, you're probably going to have a lot of heartache on that because there's also some setup. You have to, before closing, you have 45 days to declare the properties you're interested in, then 180 days to actually close. So it's not uncommon if you go do 1031 exchanges that you don't just declare one property that you think you're going to buy. You might want to choose 2, 3, 4 pieces of property because more than likely there's a lot of curveballs with real estate. You want to make sure at least one of the declared properties actually does get to the 180-day closing mark.
And you want to make sure that when you are exchanging properties, they are like kind. There are specific rules around what types of property can be exchanged for others. So you want to make sure that you don't run afoul of that. And what I think is great about 1031 exchanges is it's not a one and done. You can actually rinse and repeat this strategy. So you might buy one property and hold it for a number of years, and then 1031 into another property and hold it for a number of years. And you can keep kicking that can down the road until ultimately one day you sell your final asset, and that's where you would end up paying the capital gain. Or if you die with the asset and you leave it to your heirs, they'll actually get a step up in basis on that. So there is some tax planning, assuming that certain qualifications are met as you work through.
And also, I mean, one limitation that I think of that people run into is that you have to always buy same price or higher.
Yep,
so that
right.
sometimes can be, so if you think you're going to be downsizing and doing some unique things there, there are some catches or limitations to it. Also, I want to give a word of caution because, you know, you've heard us speak very favorably on house hacking. We love house hacking because it's a way that you can actually get into a primary residence that you all, like a duplex, a triplex, or a quadplex, where you not only is your primary residence, but it's also investment property. We have other tenants in there paying, but it does complicate that whole Section 121 with the tax-free gain plus the 1031. So just make sure you do your research, maybe even hire a tax professional to navigate those complexities.
Another thing that we know is true of real estate is that there are other costs associated with them. If we're having to borrow money to pay for them, we have maintenance, we have other things that go into it. Well, one of the great things, whether it's your primary residence or whether it's an investment property, is you are able to deduct some of those expenses. If it's your primary residence and you're an itemized deductor, you can deduct the mortgage interest and you can deduct the property taxes. If you're an investor, you can deduct the expenses associated with managing and operating the property. It won't flow through on Schedule A, it'll flow through on your Schedule E, but you can keep track of the costs that you're incurring in real estate, and you can use those costs as a means and a mechanism to decrease your overall tax bill.
Yeah, and it's not uncommon that I see people who own multiple real estate properties also to deduct some of those direct business expenses, the travel, the legal accounting fees, the office space, advertising, maybe even a salary for the, a family member that's managing the properties. All those things can be qualified expenses if they're structured properly, and it's something that a lot of people take opportunities out of.
Another big benefit of real estate. Now, this is specifically on the investment side. This does not count towards your primary residence, but if you are buying commercial property or you're buying residential property for investment purposes, you are actually able to depreciate that asset. Brian, you're the accounting guy, you're the CPA. Walk through, what does it mean to depreciate an asset?
Well, there's several things to know. First of all, you don't depreciate land. It's only the building structures that you're depreciating. But guys, this is a big one. Now, residential is typically the life of residential property is 27 and a half years. Commercial property is 39 years. And look, this is something that I always tell people is that you got to pay attention to, if you're going to sell this property in the future and gains, because depreciation recapture is a true thing. So a lot of times, like if you have a primary residence and you forego the 121 tax-free exclusion, decide to turn it into rental property, be careful with some of those things, because the depreciation recapture is actually a real thing that you need to pay attention to. But a lot of people get caught up in that. But the thing I like to talk about, and this is where we get excited with commercial real estate, cost segregation. I mean, anything that is not long-term assets. I'm talking about anything that really has a life expectancy less than like 15 years, like the sidewalks, the sheetrock, the fixtures in the buildings, and so forth. You can accelerate the depreciation on that if you have the income to offset it. There are limitations to how much is, whether it's passive property or you're actively managed. There's all kind of limitations, but you can truly accelerate a lot of deductions with cost segregation studies.
As you can imagine, if you're able to take a lot of these deductions and take a lot of this depreciation, it can potentially have a huge impact on your tax bill. But you want to make sure you know what you're doing, because Brian always says this: the one group of people that you do not want to run afoul of is the IRS, because they're the folks with the guns. They can come and take your stuff. So make sure that before you enter into some of these more complicated transactions and some of these more complex tax strategies, you've actually measured 2, 3, 4 times, and you know what you're doing, so that you don't get yourself into a bad situation. So another benefit of real estate, Brian, and this is something that changed with tax laws a couple of years ago, is now real estate, you can actually have passive income and pass-through deductions based on qualified business income. It was something that changed a number of years ago, where essentially you can look at the net profit across your real estate properties and have a deduction up to 20% of that net income. Now, this will be going away in 2025, but for real estate investors right now, it's a huge tax benefit that exists on the tax return.
Yeah, I thought it was so interesting when we were going through the lawmaking process, the legislation, is that they carved out so many professionals from qualifying for this QBI deduction. But real estate professionals, architects, those type of things, all seem to be somewhat protected. And I thought you can tell that the real estate lobby is strong. The force is with them. So it is a benefit. Their ability to lobby to keep that QBI and those deductions in there is something you can actually benefit from if you are a real estate investor.
And then the last thing that's just worth noting in terms of decreasing your taxes is one of the big benefits of real estate. If you go out and buy an investment property and you're generating income through that, that income is not considered self-employment income. It's considered passive income, not subject to self-employment taxes. So if you've ever done any sort of side gig or side hustle, or you're self-employed, you know how cumbersome those self-employment taxes can be. You're having to pay both sides of Social Security and Medicare. Well, in a number of circumstances, rental income as it's flowing in is not considered self-employment, so it's not subject to those FICA taxes. So that can be a lower tax bill than income otherwise.
Now, that is a positive that it's not subject to that 15.3%, but there is a negative to it, is that it also doesn't qualify for retirement plan contributions.
That's right.
A lot of people, like, well, hey, I had that type of income. No, but that wasn't subject to the 15.3. It's not wages, so you don't get to count it towards retirement contributions. Just something to be aware of. But still, real estate, as you can tell, has tremendous benefits. And that leads to our next big legal loophole, or tax minimization strategy, which is own a business.
Yeah, this is the one that you hear about at the cocktail parties. So people like to talk about real estate. That's the one that they get excited about. But when you think about owning a business, business owners, they get all the benefits. They're able to write off everything. If you don't believe us, take these people's words for it.
It's a write-off for them.
How is it a write-off?
They just write it off.
Write it off what?
Jerry, all these big companies, they write off everything.
You don't even know what a write-off is.
Do you?
No, I don't.
But they do. And they're the ones writing it off.
How many conversations you've been in like that?
Well, I mean, I think because the genius of Seinfeld is that realize this is from the 90s, right? We didn't have social media like we have now, but when I watch all the videos that tell you all this stuff that's deductible, it's kind of like what we started the show with at the top, was that if you own a business, everything's deductible.
Everything.
I mean, and it's the craziest thing. So we actually want to kind of separate the fact from the fiction. Here's the reality of the situation. And the first thing we were going to cover was business structure.
Yeah, the way that you own your business can have an impact from the way you pay tax. I mean, there are other impacts that come into it between liability protection and those sorts of things. But whether you are a sole proprietor, you're an LLC, you're an S Corp, or you're a C Corp, there are different implications to how you structure your business because they're not all taxed and treated the same way.
Yeah, I mean, if you think about the progression of a small business owner, they start off as a sole proprietor who's just doing a Schedule C, and then after they decide they want some legal protection, they might become a single member LLC, still taxed on a Schedule C. But, you know, they will progress, and you'll see like LLCs that are taxed as partnerships. You'll even see LLCs that are taxed as S Corps. So what's the difference between, like, when you see people talk about an LLC versus an S Corp? Here's some key things just to point out. Now, look, this is oversimplified, but you'll still get the point. A lot of your LLC income is going to be taxed subject to self-employment tax. It's going to be subject to the 15.3%. All of it is. What I have are to a point, up to the Social Security tax limit, and then you're subject to the Medicare to infinity and beyond. So that's one thing. So then some very creative people in states that accept S corporations have recognized that, hey, S corps have a unique advantage in the fact that you can have what you make, because you have two different components with your ownership. You have you're working in the business, meaning your wages. What would you have to pay somebody to do the job you do within your business? And then you have your income that is derived from you being the owner or the investor in the business. So that's why you can quickly see it. This creates an opportunity that if you underpay yourself on the S Corp side, you're avoiding a lot of payroll taxes. But I tell you, be careful. Do not try to skirt the IRS to where, because we were talking to somebody recently in the last week, Bo, this happens all the time, where he told us, he said, yeah, so-and-so just told me I need to pay myself $40,000 a year, and then I could take the rest as just distributions and only pay income tax. I'd avoid the 15.3 self-employment tax. And I was like, yeah, that sounds like an audit waiting to happen, because could you pay somebody $40,000 to do what you do in this business? He's like, of course not. And I'm like, yeah, that's exactly what it's going to feel like when you sit across the table from the IRS. So go and figure out what you really would have to pay somebody. Don't get cute with it. And then you can, yes, the owning of the business allows you to have a little different tax treatment on that component, but be very respectful to make sure you don't run afoul of this rule.
I love it. Another huge benefit when you own a business. We've talked about how retirement contributions can be fantastic from an employee standpoint, but as a business owner, retirement contributions can be fantastic from the employer standpoint, because not only do you get to participate, specifically if we're talking about 401ks, as an employee, where you can do a $22,500 salary deferral, or if you're over 50, you can do a $30,000 salary deferral. You can also do profit sharing contributions. It would take your contributions all the way up to $66,000 or even higher if you're doing the catch-up. Well, even once you graduate past that, there are other types of retirement plans you can bolt on, like a cash balance plan, where perhaps you as the business owner can not only max out the salary deferrals and not only max out the profit sharing, but you could also do six-figure contributions into a cash balance plan where, when you look at the total cost of the plan, you say, okay, well, I've got to put this much in for my employees, and this is how much administration costs, and this is how much I have to pay for record keeping, and I add up all those costs. Well, if I'm able to save this much money based on my income tax rate, I'm actually going to save more in taxes than the entire plan is going to cost me. It is a fantastic benefit for small business owners that have had some financial success and have a lot of discretionary cash flow to be able to fund these. It's a huge way to legally decrease your tax bill in a given year.
Since these cash balance plans are on, they're defined benefit plans, not defined contribution like your 401ks, so they have actuarial calculations. When these things, when I first heard about them, the only people offering them were usually associated with high cost insurance products and investments. I'm happy to report now that there's an entire industry out there where if you want index funds in your cash balance plan, you can have index funds in your cash balance plan, because I feel like this industry's evolved to where it's created a lot of opportunities. Now, the only catches on these things, I always like to give you the asterisks, is that this is not something, if you had just one good year, you kind of say, well, let's go set up this plan and we'll be good to go. No, this needs to be something that when you set it up, you know that going forward for the foreseeable future, at least 3 to 5 years in the future, you're in a good, stable place with this. And then, of course, there's also, you'll get a big education on how actuaries work, also how Pension Benefit Guaranty Corporation works. There's lots of moving parts on this, but it can be very effective, even though it's complicated. It could be something for high-income people to really take advantage of.
Another thing that you can do as a business owner, if you do operate a business that requires a physical location, whether it be an office or a warehouse or a storefront or whatever that may be, one of the things you as a business owner can do is you can actually buy the real estate itself, and then since you have the operating company that's working out of the real estate, you can actually pay yourself rent. What a wonderful benefit. Instead of you paying rent every month and it going out to someone else, what if you as the business owner could then pay it to yourself? So it's a great benefit, and it's not uncommon for business owners to acquire a piece of real estate, operate their business out of it, and then one day, even in the future when they sell the business, they continue to own the real estate, and that becomes part of their retirement income, part of their cash flow in financial independence. So it's a huge benefit available for business owners that also need a real estate location to operate out of.
Yeah, I don't mind sharing. I've been in the game long enough that I've worked with a lot of business owners. That's actually how I kind of felt like I got my way into this industry. If I could help a business owner save some taxes, they loved me. And I've now seen them go from starting companies to selling companies, and it's not too surprising to find that a lot of these business owners will make more on the real estate of the building they bought for their business than even the liquidation of their business when they retire. So it is definitely something that's very valuable, very effective, and even tax favored. So don't overlook the opportunity and benefits of paying rent to yourself.
Another big benefit that exists for business owners, again, this is similar to what we discussed in the real estate section, is that you do get a deduction for qualified business income inside of a business that meets specific and certain qualifications. Again, this changed with the Tax Cuts and Jobs Act of 2018, and it is set to sunset, to expire in 2025. But right now, assuming you have a business that qualifies for the qualified business income deduction, you get a 20% deduction on the net profit generated from the business that can be a huge tax offset. So you just want to make sure that you understand the rules for qualifying businesses, and you want to make sure that you're seeing that reflected on your tax return, at least for these next couple of years.
So we've gone through a lot of business things, but I want to just go through in rapid fashion a few honorable mentions, because these were good things, but not as good as some of the other things. I think it's important. You hear people talk about the deductibility of vehicles. Yes, there is a potential, but it is gray, because remember, there's all kind of restrictions. What is the weight of the vehicle? How much is it used? Because if it's not used for 50% business purposes, and by the way, make sure you're not counting those commuting miles in that process, it can get complicated, but it is worth noting, if you do your research, there's potential that vehicles could be a good deductible expense for you. Also, meals. Now look, during the pandemic, the government did something that was very unusual. They made meals 100% deductible. They were trying to really help out in the food industry, but it's gone back to normal now that we're in 2023, where it's only 50% deductible. And then last thing, we've even reacted to some funny clips where people just basically say everything's deductible as long as I slap my logo on it. That's not exactly true. You can't go buy a brilliant suit and just because you signed your name on the inside sleeve, it is the perfect thing. But it is true that you can go buy promo wear, logo wear, and other things to give out to customers, to give to your team members, to even wear yourself as a uniform. Nothing wrong with that. So doing promo type stuff like that is a very effective and actually a useful deduction for business owners.
All right, Brian. So we're talking about ways that we can decrease our taxes. We've talked about retirement plans and investing, and we've talked about real estate and being a small business owner. Now, this next one I think might be surprising. And at first sniff, you might say, oh, wait, what are you guys talking about? But this can be a substantial tax savings technique for you. It just may not be one that you thought of, or it may not be one that is practical until you think through it. But you actually have the ability to choose where you live. And depending on where you live and where you choose to domicile can have a huge impact on what your overall tax bill is.
Well, I think this has gotten so much attention because, during the run-up in real estate, here in Tennessee, there were actually real estate companies cutting promo videos who would show people very luxury neighborhoods, high dollar, high value neighborhoods, telling California residents that your tax savings each year would actually pay for this beautiful mansion of a house.
Yep.
Because if you compare the 13% taxes that you'd pay in California to the 0% potentially you could be paying in Tennessee, it probably could pay for a lot of real estate. So it is worth noting that there are opportunities to live in tax-free states.
Yeah, if you want to know what states those are, when it comes to income tax specifically, Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming all fall into the no income tax states. Now, Washington and New Hampshire have unique things there that you need to be aware of as it relates to capital gains, but these are lower tax states. But this is specifically around earned income. You do not necessarily need to live in one of these states to get a benefit. There are other states, like the state of Georgia, that have huge benefits for retirees. They provide a large exclusion on retiree income, and there are even some states that will exclude pensions from the amount of taxable income on your state tax return. So when you think about where you're going to work, where you're going to start a family, where you're going to grow a family, and even where you want to retire, you may want to think about what state you're going to choose to live in, because some states are more attractive from a tax saving standpoint than others.
So yeah, you can see choosing your states can have an impact. By the way, for everybody who out there has got a little adventure in their heart, there's one that's out there and it's legitimate. And we're like, we cannot do a tax avoidance show without at least putting this in there. Puerto Rico. This is, I've heard so many rumors, and I've even gone down the rabbit hole of researching this. Not that I came really close to moving there, but it is interesting that if you actually have a business in Puerto Rico, there are some unique opportunities. It can be a business, it can be investments. There's substantial opportunities to where if it's structured appropriately, look, there's a lot of stuff you need to research on this, but you could avoid a lot of the federal income taxes and pay a much lower local tax on some of this. It is something you ought to at least be aware of, but here's where I'd like to close it though, Bo. What I'd like you to do is be building so much financial independence that you get to live where you actually want to live.
I love it.
Not to do it just to minimize taxes. We talk about it all the time. I don't want your tax planning to be the tax tail wagging the entire dog, because tax and good sound tax planning can be very effective in essentially boosting your financial goals. But don't let that make all your decisions. There's a lot more to life than just minimizing taxes.
That's right. No one loves paying taxes. But what I hope you've learned here is that if you are willing to do a little bit extra, a little bit more research, think through a little bit more around your financial plan, there are ways to minimize what you pay in taxes. Remember, tax evasion is illegal. It'll get you arrested. It'll get your stuff taken away. But tax avoidance is highly encouraged. And what we want to help you do is figure out what are the prudent and practical ways that I could avoid paying any more taxes than I absolutely have to. Maybe for some of you that involves moving states. Maybe for other of you it just involves increasing your 401k contribution. But we think that those folks who can practice tax avoidance are much more likely to keep more dollars in their back pocket so that they can save more, so those dollars can grow, so that they can have a great, big, beautiful tomorrow.
Guys, you've heard us talk about the tax resource. I want you to go to moneyguy.com/resource. Tons of free stuff out there. Look, I think if this show showed me anything, is that if you hang out with us, we'll show you there's actually a better way to do money. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy team, out.